Head of Membership at NZIER, also a CFA charter holder and Vice Chair of the CFA Society New Zealand Board. I'm delighted to be joined today by Adam, Mary Jo and Zoe for the webinar on interest rates on the move. Now, before I introduce and hand over to our panelists, a few housekeeping announcements. Firstly, this webinar will be recorded. Also, as we head into the end of the year, the CFA Society New Zealand has some exciting events coming up, all on our website, so please do go and check it out. So firstly, we do have our spring networking drinks on in Auckland this Thursday at the Lula Inn. Also, in terms of the next event, we've got the Unlocking the Power of Alternatives happening on the 4th of November in person in Auckland and also online, where you'll hear from leading voices in venture capital, private credit, infrastructure and real estate as they unpack how institutional capital, maturing markets and global connectivity are reshaping opportunities across the country. We also have our AGM and CFA program charter holder graduation ceremony happening at 4 p.m. at the Alvarian office on the 3rd of December in Auckland. And of course, our CFA Society New Zealand Investment Conference, which is happening on Thursday, 4th of December at the Grand Millennium. So this conference includes some world-class speakers that we're bringing in from overseas. So whether you're looking to expand your professional network, sharpen your skills, or stay ahead of the latest trends, this is a must-attend event. Tickets are highly sought after, so do secure early bird pricing before this Friday. Now, let's get back to today's session. So in terms of what we're seeing after the OCR has peaked at 5.5%, we now have it's been cut to 2.5%, and markets are now talking about the extent of which cuts will be cut further. So in terms of what we're going to discuss today, we're going to cover what rising or falling OCR really means for household, businesses and investors, and what might influence where the interest rates go from here. First, so introducing our panelists, we have Adam Richardson, Director of Financial Markets at the Reserve Bank. So Adam, in his role, he leads the directorate responsible for the bank's market operations, balance sheet management, and policy advice on domestic and international financial markets and international economies. We also have Mary Jo Vergara, who's Senior Economist at the Kiwi Bank. And Mary Jo will be telling us what she's been hearing from on the ground from businesses in terms of what's going on with the New Zealand economy. And then we also have Zoe Wallace, who's investment strategist at Forsyth Barr, who will bring it all together in terms of what recent development means for the investment landscape. In terms of how the session will be run, we will have, please put in your questions in the chat box there, and I'll be moderating them at the end for 15 minutes. Each panelist will speak for around 5 minutes or so. And after that, I do have a set of pre-prepared questions for which the panel will be discussing to cover where interest rates are and where they'll go from here. And after that, 15 minutes of Q&A from the audience for which you put into that chat box there. So without further ado, I'll hand over to Adam now. Thanks, Adam.
Thanks, Christina, and thanks for the invite to be here. Yeah, so I was going to start with a bit more of a high-level sort of approach. What are some of the key trends that are driving interest rates recently and in terms of the outlook? I think there's sort of two competing forces that are going on at the moment, and this is probably something that's been in place for sort of a year or 18 months in New Zealand. So one is there's still a bit of a hangover from the high inflation post-COVID period that's driving firm household pricing behavior, and that's sort of acting against the force of essentially a weak New Zealand economy. So there's a lot of spare capacity in the New Zealand economy at the moment, and you've got sort of those two big forces competing with each other, and the relative strength of those forces is something that's I guess shaping interest rate trends and the outlook for rates. So I think if you sort of parachuted into the New Zealand economy today without much of a background and all you saw was economic outcomes, I think you'd be quite surprised when you looked at both the setting of interest rates in terms of interest rates being sort of close to neutral, and the outturns that we have seen for the past year in terms of inflation. So, in particular in the last outturn where we saw annual inflation at 3%. And what's really going on there is that sort of hangover from the post-COVID period. The research we've done suggests that, firms, households, still very influenced by that in terms of their cost-setting behavior today. And that, I guess, for now is offsetting the impact that that really large degree of spare capacity in the New Zealand economy should be having in terms of the inflation outcomes that we see. I guess in terms of the outlook from here, our assumption is that you get those forces continuing to offset but moderate at the same time. So, our expectation is that the interest rate cuts that we've delivered over the past year will continue to sort of boost the interest rate sensitive sectors of the economy. And you'll start to see that spare capacity beginning to be absorbed. But at the same time, we're seeing, I guess, that sort of hangover inflationary pressure continue to moderate. And so that's essentially driving our assumption that we'll see inflation essentially fall from here. So we expect inflation to fall towards the midpoint of our target band over the sort of first half of 2026. And it really is that, I guess, moderation, sort of normalization in pricing behavior that's driving that and sort of allowing space for the economy to pick up over that period at the same time. So yeah, that's the sort of big trend that we're sort of seeing at the moment, and that's played out over the past few years. But happy to delve more into that through the questions as well.
Thanks. I'll now pass on to Mary Jo, who's going to cover what she's seeing on the ground in terms of what she's hearing from businesses.
Yeah, thanks again as well for inviting me onto this panel. It's gonna be really interesting. But I guess from our perspective, it's always a real privilege and lots of fun to go out and speak to businesses because economic data is fundamentally delayed. So getting these on the ground insights is always really insightful for us in terms of where things are currently, where we think it's going. And what businesses are telling us right now is that it's still pretty tough out there. Of course, there is the global risks that are hanging out with that have really dominated the headlines this year. It's funny because we had just changed our cringy catchphrase for 2025 from survive till 25 to thrive in 2025. But I think there's only one person thriving this year, and that's Trump. He's loving all the attention that he's getting from all eyes on the White House, really. But Trump's tariffs really have caused quite a disruption, and it's paralyzed many business owners, put plans on hold. And so that really killed the momentum that we had going into this year. So that confidence heading into this year really has faded across many businesses. What we're hearing as well is that interest rates aren't yet at those levels that are exciting business owners just yet. Encouraging a bit more risk taking from business owners or investors. There's no demand out there as well to kind of help that along. But the Reserve Bank has lowered the cash rate into what would be considered more stimulatory territory. So conditions are set for a better 2026. And business owners are looking to next year with more confidence. They still remain quite cautious. Talking of investment is still probably too early. Just the lack of demand out there is hindering any plans to expand. And the same goes with hiring as well. Business owners are still, when we're talking to them about recruitment, they're still thinking more about reducing headcount than increasing headcount. So that's kind of the discussions we're having. Of course, it's very much at the aggregate level, the national level. It's very different at the regional level. We were just talking offline, saying how the South Island is way outperforming the North Island, specifically Queenstown and Christchurch. They very much live in their own little bubble where the outside world just doesn't really exist. Demand is still pretty strong in those areas, supported by commodity prices and tourist flows. Just seeing that lift activity in those areas. But the North Island is very much dependent on the housing market, and it's been quite weak in Auckland and Wellington especially. So there's been no kind of wealth effect. So businesses there are a little bit more, I guess, pessimistic, and activity is quite low in those areas. But I mean, overall, we get the sense from businesses that the worst does feel like it's over, and 2026 should be a better year, and it's really just that pushing out of the recovery we expected this year into next year. But yeah, happy to delve into that as well.
Thanks, Mary Jo. And now Zoe will tie it all together in what it means for the investment landscape.
Thanks, Christina, and thank you to Mary and Adam for their comments already. Look, I think one interesting thing has been that when you look at where the official cash rate has come down from 5.5 to 2.5, that's, you know, a reasonably substantial amount of easing that's been delivered into the economy. The key part is the part of the interest rate curve that's really impacting is those shorter term rates. And I think the Reserve Bank alluded to this in their recent statement as well, as we haven't seen longer term interest rates come down as far. Those are being held up. There's about an 80 to 90% correlation between our longer term interest rates in New Zealand and longer term interest rates globally as well, particularly just related to the US. And so US interest rates have held up at relatively high levels, and they have only just recommenced cutting their short-term interest rates this year. And so that's actually been holding up the longer part of our rate curve, which means that you haven't seen perhaps as much stimulus delivered as if you'd had every central bank cutting quite in concert over the last few years. I guess another couple of factors from a financial markets perspective. So one is the New Zealand equity market. So the NZX 50 has had a really tough couple of years, and that's really driven by two factors. So one is cyclical weakness in the economy that we've been seeing. Obviously, GDP's been pretty lackluster over the last 2.5, 3 years. And that's having an impact on local businesses, particularly those that are exposed to higher interest rates. And the other part of that is that generally we have quite an interest rate sensitive equity market here in New Zealand. And by that, I mean we have a lot of quite stable, not as sort of exciting as some of the AI tech stocks that we see in the US, but more stable utilities companies dominate and healthcare dominate our local index. And with that, they do tend to be quite high dividend paying. And when you see higher interest rates, the relative attractiveness of some of those companies is diminished, because you can essentially just park your money in a bond or park your money in the bank and earn a similar dividend yield or similar return that you might have received from those dividend paying companies. Now we are starting to see that turn as interest rates have fallen. So you've just seen particularly the listed property market, both here and in Australia, start to pick up over the last few months, but also a bit of a turn in the New Zealand equity market as well. The final point I might just make from a financial markets perspective as well is that with our central bank cutting interest rates more aggressively than we have seen offshore, those relative interest rate differentials between us and particularly Australia and particularly the US has seen a lot of downwards pressure on the Kiwi dollar. So, you know, New Zealand dollars come down reasonably dramatically against both of those crosses. Now that's a great thing for our exporters because it means their revenues are even better when converted back. And as Mary Jo alluded to, our dairy and particularly our meat sector have been doing really well on the back of higher commodity prices over the last year and so. But it also does raise the risk that inflation might tick up on the tradable side of things. So I might leave it there, but happy to take questions as we go through.
Thanks, Zoe. I do have some pre-prepared questions now to get the discussion going with our panel, but certainly please do put in your questions in the chat box and we will get to them later on after our panel discussion, which we'll have for around 15 minutes or so. So one of the first questions I had is, why do you think, and that's for all the panelists, why do you think it's taking longer for demand to be responding to the substantial amount of monetary policy stimulus that we've already had than has been the case historically, acknowledging that, of course, the New Zealand mortgage book does tend to be more on the fixed term rates, but what is driving that lag that we're seeing more than what we've previously seen in the past?
I'm happy to jump in. Oh, you go.
Yeah, maybe because I can pick up one of the points you made, Zoe, in your good summary as well. So I think overall, when we take a step back and look at least the transmission from our cuts to financial markets, it's sort of broadly played out as we thought. There are a few, as usual, sort of, what would you call them, idiosyncrasies to this cycle. And one of them is the one you highlighted, Zoe, around, you know, you've seen term premium rise. internationally, and that's obviously fed through into New Zealand's market in terms of keeping our long rates elevated. And so that's something the sort of committee sort of, called out in our record of meeting and is aware of. We've got as long as we're aware that that's happening, we have the tools to sort of set monetary conditions where we need them to be, but it is a sort of force that's played out. I think the other thing to highlight is that there's still transmission to come. So we kind of think, it takes about 18 months to sort of get that full peak in terms of the impact that cuts tend to have on the real economy. So yeah, I guess there's also the sort of wait and see type approach that we will see this continue to play out in terms of the cuts that started last year. Yeah, so I think in terms of the transmission to financial markets, it's kind of making sense and passing through how we thought, and then it's sort of getting a handle, I guess, on what's driven this deterioration in growth more recently. Yeah.
Did any of the other sorry.
Yes, I think probably an interesting comparison when you go back to the last big rate cutting cycle was really in the GFC, right? This is sort of the last time we saw growth this week. And it is pretty much comparable when you look at, kind of the downturn has been more drawn out this time round than what we saw during the GFC, which is much more a sort of short, sharp financial sector generated shock. So I think that's had a bit of an interesting impact. But the other thing is just that inflation has still been elevated and household living costs remain pretty high. So it's really, and I think a couple, you both touched on it before, is that consumer confidence piece, particularly with the housing market in the doldrums. This is one of the biggest housing market downturns we've had, particularly for big centres like Auckland and Wellington, in decades. So it sort of far surpasses the GFC in terms of that level of things. But also, households received more relief in terms of the relative quantum of the interest rate cuts in the GFC than they have received this time around, although it took longer to feed through because everyone was on 5-year fixed rates this time around. Everyone's fixed a bit shorter. But I think that household confidence challenge has really been missing. The other factor that you're seeing that's going to make it a little bit harder, in my view, going forward, is that you've now no longer got a population growth tailwind. Migration's really tailed off. So you've got population growth down and sort of, I think it's below 0.5% year on year, which means everyone has to spend more, do more, produce more to actually get growth picking up on the other side of this.
I think Adam and Zoe have covered it really. I think the point I'd stress is just around how most of the household budgets are still going to those essential items that are the ones that are rising in price. So even though we've seen quite discounted, retail goods and more fun things, we haven't seen any demand there. And we're seeing that in our own credit card data. There's been a significant amount of easing and households have been positioned for that. As Zoe said, the mortgage book's really shortened up. So they've been able to take advantage of those rate cuts, but it's all just going towards spending on those essential goods rather than more disposable income being spent elsewhere. And that should change, as Adam said, that transmission will continue into next year and we'll get that effect in 2026. But also I think just what's happening overseas really has delayed a lot of things. We are expecting a lot more growth this year. And I think we were again positioned for that because of how the mortgage book looked at the end of last year. But it really derailed plans to expand or invest or to spend a bit more on businesses. So that was a really negative demand shock there that's kind of delayed that recovery.
Yeah, and I think that that divergence between what households in terms of spending, really came through in yesterday's Q3 CPI data as well, with those strong increases in the areas which are household living costs, such as local authority rates, energy prices, versus those still really weak pricing when it comes to furniture, appliances. So when it comes to that discretionary part of household spending, that's still very much weak demand there, putting pressure on prices in terms of that weak pricing environment. So how can we make sure policy making is forward-looking rather than in the rearview mirror, given the lag that we have in the data? What are the key leading indicators that you place more weight on in order to have that more forward-looking when you're making policy, essentially? I might start that with Adam. given it starts with policy?
Sure. So I think a few things here. One is it's ingrained in our framework to some degree. So, our inflation target is a forward-looking medium-term inflation target, and that kind of comes from this issue where there's lags to monetary policy, and there's also this difficulty with just assessing, what's going on in the economy today, given the lags we see in data and that sort of thing. And so there's a few things we do to try and deal with that. One is sort of continuous improvement of what we call our nowcasting ability. So purely our ability to understand what's happening today. So part of that is, I guess, getting around and talking to businesses as often as we can to get sort of as up-to-date information as possible. Part of it's the sort of modeling and data, so taking as much as we can from sort of new high-frequency data sources. We've done a lot of work internally over the past couple of years. We publish one of the models that we use on our website, which gives sort of a weekly update of our estimate of current quarter GDP. So, part of it is just, understanding more fully what's happening on the ground today through, both your engagement with the business community and the data that you use. I guess the other one is it sort of promotes the need for the research that we do at the bank. So obviously we can't, forecast the next shock. That's not going to happen. But what we can do is, spend a lot of time understanding what's happening today, what are the key drivers, and then use our research to sort of understand how persistent those drivers are likely to be. So an example will be, say, what we've seen with the tariff increases announced this year. We spent a lot of time, I guess, updating our ability to model and understand tariffs and sort of assess, what's happened historically, and then make some calls about what the likely scenarios are for us. And so, that research is sort of fundamental to making a call about how the shocks that we do see are going to play out. And then the other thing is just having an acceptance that you're not going to be able to forecast the future very well. There's always going to be really wide confidence intervals around any forecast that we make. And so the way that we approach that is to have, a good framework for making decisions under uncertainty. So that's partly why we have, a monetary policy committee, so that we can get, diverse views around where to set policy. And the other one is just, having the knowledge around when uncertainty is very high, how you should approach decision making. And so you saw that in its extreme during COVID, where we moved away from, our sort of classic try and, get as close to target as we can type, minimize deviations from target, to an approach that's more about, avoiding the costs of the worst case scenarios. And sometimes that's the more optimal thing to do for a central bank. And that's probably the extreme case, but sort of having those frameworks embedded to make sure that you're very aware of the uncertainty inherent in the forecast that you're making, and how to make decisions that are sort of robust to that uncertainty is an important part of it. Yeah.
For us, again, it's those business insights, just hearing it from the ground, how they're feeling, because that'll end up in the data that we'll see eventually. But also what we found to be, in terms of those key indicators, that's been incredibly insightful throughout this whole process, is the consumer spending. So at a bank, we are sitting on a gold mine of data in terms of daily transactions. It really comes at a daily basis, and it really gives us a good idea as to how quickly monetary policy changes are feeding onto the real economy. In 2020, we saw such exuberant demand on all retail because we were all just locked up, and we saw that really translate into our data. Big spikes in things like home contents and furnishings, and everyone was buying a pizza oven and a pet as well. So we saw that translate in the data. And then as interest rates were hiked, we saw that very big reversal, and it nicely predated the recession we ended up having in 2024. So we kind of saw that indicator at the end of 2023, and then now again, it's very much consistent with what we're seeing, how there's just been no demand for that kind of discretionary spend just yet. But there are starting to be a few green shoots, I suppose, in the housing space in terms of spending. There's a bit more spend on hardware off low bases, but there's a bit of signs of life in that space. So that gives us confidence as to how things may play out next year. But we really are sitting on goldmine of how the real economy is doing when we look into these data, into this kind of daily transactional data.
Yeah, from our point of view, I guess coming at a slightly different angle, the NZ equity market is not purely reflective of the economy. It's quite a different makeup in terms of weightings, but you can get some early indications about how things are going. And what we've typically seen through history is that often the New Zealand market actually starts to turn before you see the turn in the economic data, just because, people are trading and there's, stock prices on a daily basis. You're actually getting quite a bit of that sort of anecdotal good news, or those sort of earnings upgrades and forecasts and market commentary from companies built into those stock prices quite early on. So it's a much more timely sort of way to get a gauge than perhaps some of the official stats data is. So we've actually been seeing a little bit of a pickup, and sort of, some of the cyclicals actually looking a little bit more positive. And that's helped by the fact that you've got lower interest rates coming through, but actually starting to see a few more upgrade announcements coming through from companies as well. So that's something we're keeping a pretty close eye on.
Yeah, especially the fact that it reflects expectations, and certainly now there's the turn, you're starting to see that turn in expectations of better times to come ahead. Now, in your view, what is currently market noise, and what are the key developments that you feel cuts through all this noise? I might start with Mary Jo, just for a change.
Yeah, I mean, I guess just top of mind is that CPI data that we had. It's at 3%. It's at a high and at the top of the Reserve Bank's band. But if you look into the data there, it's those administered costs that it's keeping inflation high. So actually, if you strip that away, what really inflation is it's quite weak in terms of the domestic demand and the domestic picture. So I think it's the council rates and electricity being at the highest since the 1980s, that's all keeping inflation, I guess, artificially high in terms of how monetary policy is actually operating. So, there's still a lot of slack in the economy, and that should show through the inflation being quite weak at a core level. So that, I think, it's hard to see a 3% inflation rate, but the fact that core inflation is still quite weak tells you more about how the economy actually is performing than anything.
So those headline versus core measures.
Yeah.
The other one is probably just, it is quite easy to get quite downbeat when you open the local newspaper and you read stories about, individual companies closing down or job losses coming through. And you get this recency bias in your head of, well, that must be happening across the country, across every region as well. And I think, as Mary Jo alluded to before, what you can see is actually half of New Zealand is actually doing pretty well at the moment. It's mainly the big centres in the North Island, Auckland and Wellington, that are really struggling. Particularly, Southland, Otago, Canterbury. So basically, the further south you go, almost the more optimistic it gets at the moment. And so, it's easy to get tied into the headlines that you see, but actually when you look at, there's a decent amount of turn and a decent amount of activity, tourism coming back, particularly in Otago, less so around the rest of the country, but there's actually good things happening. And so it's easy to kind of pick out the headlines from the newspaper and feel quite downbeat, but there's parts of the economy that are actually doing really well right now.
Yeah, when it comes to reporting, you do tend to see more of that bias towards the negative aspects of the developments. And also, I guess, in terms of that balance and not wanting to appear tone deaf to the struggles of some segments of the economy as well. So it is always a tricky balance. Adam?
Yeah, I struggled with this one a bit. I think in terms of the signals we're getting from markets, I'm not sure there's anything obvious that I'd discount. I think maybe the point to make there is that, it's understandable and expected that we are seeing more volatility, more sort of, I guess, reaction, because things have changed a lot, right? Like, particularly on the geopolitics side, we've moved away from what is a very sort of stable rules-based approach to things to something very different. And so it's understandable that we have more market volatility, more elevated levels of uncertainty going on, and I don't think that's something you should necessarily discount. It's just sort of reflective of a new environment that we're in.
So for those who have questions, do put them through in the chat. There are some coming through. So this one is partly related to what we've covered just in the discussion just now. So the question being, given the current economic scenario where this OCR is trending down, we've got inflation at the top of the target band and GDP growth slowing, is it valid to question the effectiveness of inflation targeting? I might start Adam off with that, given the policy perspective.
I mean, I think that's a classic example of what happens when we see a supply shock occur, and it's sort of the hangover of that approach. I would say that, inflation targeting has faced some very significant shocks and overall has dealt with things relatively well. Obviously, we've had to dive in and look at what we could have done better when it came to the sort of high inflationary period post-COVID, and we've sort of just published some work on that, looking at sort of what our alternative policy scenarios look like. But in the end, you were sort of trading off price stability versus our secondary considerations around ensuring that we don't push the economy too high or too low, and that sort of work sort of plays out what those alternative scenarios could have looked like. So yeah, for me, I think inflation targeting's sort of well set up to deal with both the classic sort of demand side drivers that you see and these periods of supply shocks. It's just that when you see things happen on the supply side, you just naturally face tougher trade-offs, and that's what we've had to go through. Yeah.
Did anyone else have anything to add to that question?
I think one of the interesting things that you're seeing globally is just a bit more of a question mark around what level of inflation will be permissible going forward. I think there's been sort of multiple conversations over the last few years about actually, is 2% the right level? Should it be 3%? And obviously it's pretty tough. You can't really lift your inflation target right in the middle of, it's changing the goalposts as you're playing the game isn't really fair. But I think going forward, there is a question mark, certainly from a financial markets perspective, about with governments taking on increasing levels of debt, is inflation going to be allowed to be higher on average going forward from a political perspective in order to actually allow governments to be able to meet their debt obligations? And that's kind of this outstanding question for global markets and has been driving, for example, the term premium that Adam mentioned in the US. That's one of the things that's been driving longer term interest rates higher. Broader question, but yeah.
Yeah. It is some tricky issues there in terms of credibility, as you say, moving the goalposts and the longer term implications of that. Mary Jo, did you have anything to add to that in terms of?
No, I think, yeah, Adam and Zoe, I think, covered it really well. Just stressing, I guess, the point around how inflation targeting is the way that a central bank can retain or keep their credibility and what they're trying to do. So I think it's there's like Zoe saying, there's discussion around it being structurally higher for factors like in climate change and all the rest of it, but to concede that during this period is probably not the right discussion. It's more of a longer term thing.
Yeah, and I would put I guess a plug in for like this type of feedback, criticism, very welcome. And we've sort of set ourselves up so we have sort of natural check-in points where we can say, have we got the right framework? So we're sort of mandated every 5 years to do a review of, I guess, our decision-making over a 5-year period, but at the same time, whether we've got our remit when it comes to price stability correct. And so I guess when's our next one's due in 27. But yeah, we sort of have this natural process where we hear these big sort of chunky questions about how to run the framework itself, and we can sort of naturally check in every few years to sort of kick the tires on it. And that's a process that's beginning to start here for our next review.
Right, got a few more questions, and do keep them coming. So this one, I feel I get asked a fair bit when I tell people I'm an economist. So for businesses looking to refinance debt in this environment, what's your view on fixed versus floating structures today? Feel free to add your caveat at the start before you answer this question. I'll start with you, Zoe.
Without giving financial advice, some clear caveats around that. Yeah, look, I think a couple of the banks do some really good analysis on this in terms of, what your forward rates would need to be in 1 year's time to make it make sense to take, individual interest rates going forward in terms of your mortgage book. Look, I think in terms of mitigating risk, and, as Adam's alluded to, the world is getting more volatile and more unpredictable. In which case you may want to take sort of a laddering approach. I mean, one thing that's worth noting in New Zealand is we do have a very heavily reliance on fixed rates, and we do tend to just gravitate towards the cheapest rate in the curve. But, I think it very much depends on individual circumstances, how much you're happy sort of betting all of your money on black, essentially, and saying, well, hey, in 1 year's time, I'm pretty confident the rate's going to be cheaper than it is today, or no worse. Versus spreading that risk out over time and having some certainty around actually what rate you're going to pay. Mary Jo, I'm sure, will have a view.
Yeah. Also, without giving you financial advice, this is the advice. And it's that our expectation is just that most of the move in interest rates has already happened, and we're still calling for a lower cash rate from here, but that's largely priced into market, so we may not see much more movement in retail rates from here. We may be nearing the bottom, but yeah, most of the move has been made. So I think now you're just trading off that certainty because we're kind of close to the bottom, and just an extra kind of 10 or so basis points of a lower rate. So there's quite a few, this person's not alone. There's a lot of, a big share of the mortgage book that's yet to roll over in the next 6 months. So yeah, it's very much top of mind, I could say.
So the next question is around trade. So shifting trade patterns and economic drag seem to have tempered inflation expectations from tariffs. Is there a real risk that tariffs could become a driver of inflation, or are we relatively insulated?
Yeah, I mean, this is one of the key risks that we've talked about for the past few rounds in terms of OCR decisions. It's that we see on net that tariffs will be sort of a drag on the economy and inflation. But there are those big questions around, I guess, the supply side elements of it, the supply chain aspects. You're pushing activity into less productive markets. And so, we've sort of continued, I guess, as the data came out, to hold that assumption that that on net this will be sort of a deflationary impulse, particularly for New Zealand, not necessarily for other countries. And so it's sort of played out that way as we would expect, but it's definitely not a risk that we've taken off the table in terms of the positive inflationary side that can happen from tariffs. And it's not like we're at a point where we can make sort of a strong conclusion either about what those net effects are. They're still playing out. They're still to be seen. There's still uncertainty about the exact regime that will sort of persist into the medium term. So yeah, it's something that we're still monitoring to check if those assumptions still hold. I mean, that's not a very conclusive answer, but I think that's just the reality of it, is that we're still looking in terms of the impact on the markets that we trade with, and we're still not certain 100% around what the exact tariff environment will be going forward.
Yeah, we'd think the same. It's been really interesting watching the tariff situation because, you know, in the US, you'd think that it's very much inflationary and you'd see that inflation spike there, but it hasn't quite happened just yet. There's been some, you know, forward, you know, pulling their orders forward so that you don't really see that that flow through just yet. Maybe it's more of a 2026 story. At the same time, because it hasn't really been felt there, we're of the view that it is also deflationary for New Zealand for the reasons of a drag on global growth, you know, export prices being weaker, or the fact that you'll see this diversion of trade, which we haven't quite seen just yet, but that's probably again a medium-term story that things that should have gone to the US say come to us at a discount. So I think those factors, our view is on balance will be more deflationary for New Zealand.
Yeah, I think just adding to that with sort of a bit more of a global lens, you know, what you're seeing in the US is there has been a huge amount of stockpiling, to Mary Jo's point, you know, and you haven't seen the price impact fully come through yet. It is starting to show up, particularly in certain pockets, and expected to, I think, to come through more. I think the broader question mark, though, is whether that's a one-off shock. Particularly, this is one that the markets have a big question about. Is that a one-off shock? Is it transitory, to use that famous word? Or is it something that's actually going to then spill over into more generalized inflation pressure for the US? And I think the consensus at the moment is that it's unlikely to cause a general spillover in broader prices at this point in time, just given some of the sort of the areas of weakness you're seeing in the US economy. Although it's very much dependent on what sector you look at, but the view is that it's going to be transitory and allow the Fed to continue to ease interest rates at least once more this year and into 2026.
Yes, I guess a broader question is that with the shutdown and the lack of data coming out of the US, how do we make sense of what's going on out there in terms of the outlook? And like going back to what we talked about, noise versus what's real, how would you, I guess maybe starting with Adam, how would you start to think about what's going on with the US given the absence of data?
Yeah, I mean, there have actually been some good sort of third-party private monitoring set up. So the stuff that the Billion Prices Project does in terms of monitoring online retail prices, they sort of split it into a sort of traded and non-traded type category, and so you get some pretty good signals from that high-frequency data. Then the question mark is how US firms then absorb that into their margins. I guess you see the endpoint, but not necessarily the choices they're making, and therefore how that might play out medium term in terms of inflation. So I mean that does muddy that interpretation, but I think you can still build up a broad picture from the sort of third-party private data to get a good read on what's happening. It's not perfect, not having that data, obviously, but yeah, we've sort of thought about what channels we can look at to keep monitoring tariff pass through.
If anyone does have any further questions, we do have a little bit of time left. So do feel free to put them through. Otherwise, mindful that some people join midway through the webinar, so I will run through what are some of the events that we have coming up for CFA NZ. Please do go onto our website to have a look as well for the details of that. So firstly, of course, we have our spring networking drinks on at Lula Inn this Thursday in Auckland. Also in terms of an in-person and online event, we've got the Unlocking the Power of Alternatives happening on the 4th of November, where you hear from leading voices in the venture capital, private credit, infrastructure and real estate as they unpack how institutional capital, maturing markets and global connectivity are reshaping opportunities across the country. We also have our AGM and CFA program charter holder graduation ceremony happening on the 3rd of December in Auckland. And then, of course, the CFA Society NZ Investment Conference, which takes place on Thursday, 4th of December, and it's at the Grand Millennium, all-day event. It includes, we've brought in some world-class speakers from overseas, focusing on the geopolitical environment. And so whether you're looking to expand your professional network, sharpen your skills, or stay ahead of the latest trends, this is a must-attend event. Tickets are highly sought after, so do secure your ticket before early bird pricing closes this Friday. Thanks everyone for making the time to come along to this webinar. As I mentioned at the start, this is recorded, so we will be sending through a recording at the end of this. Thanks everyone.
Thanks, Christina.
Thank you.